Welcome to part 2 of Navigating the Changing Buy-to-Let Landscape, presented by Roger Morris. So Roger, over to you.
We're now going to do, I think, an overview of the most complicated part of buy-to-let that I think, as a mortgage advisor, you might be asked to give a factual explanation. Now, let me be clear. This is something that you shouldn't ever give tax advice on, but you might want to give a high-level factual explanation only if you feel confident. But the information I'm now about to give on how a landlord can potentially or can transfer properties from personal ownership to a limited company, and the taxes and the costs that are involved. Normally, I do this section with John McCaffrey and Rowan, but today we don't have them. So I'm just going to give a basic explanation for your knowledge only. This is not for you to go and give this advice to a customer. My advice to you is, when a customer asks about the costs involved in incorporating a portfolio, it's logical to say you must expect to pay stamp duty, capital gains, and early repayment charges as a potential of one or all three of them. What I'm going to do now is just help you on that journey to understand the vast majority of landlords will have to pay the appropriate taxes. However, some, and I say some, a very small minority, may not have to. But the only person who can quantify that and give that advice is going to be a tax advisor. So let me just give you this first example of moving one property from personal ownership into a limited company. And it's actually was a really good friend of mine. Vicky was her first name. I won't give a second name because of GDPR reasons and just to keep her own privacy personal, but she's quite happy with me using her first name and the example of what she went through and how the wrong person who's not qualified can give terrible advice, which is why I would never, ever give tax advice or ever put down in writing the potential costs of stamp duty and capital gains. Either direct them to HMRC's website or have a tax advisor quote them. But Vicky had purchased a property in Wimbledon in 2001 for £250,000. In the December of 2021, it was worth 1.1 million, and she had outstanding £632,000 in mortgage. I'm not going to get into how come a mortgage balance increased way above the purchase price, especially with not having any other buy-to-lets. But let's just leave that point alone, apart from she had a mortgage of £632,000. Now, because she is a top-rate taxpayer, and because the accountant was trying to find ingenious and clever ways for her to carry on getting the ability to offset 100% of the mortgage payment as it was in personal names, the accountant made a series of very inaccurate decisions and gave Vicky some wrong information. What the accountant said was she needed to arrange a new mortgage with a limited company, that she could transfer the property using consideration, in other words, transfer it through at the value of the mortgage, in other words, below market value, and it would be the right outcome for her and it would save her a lot of money. The only real example of when a property is to move from personal names to limited company, or the sale of a personally owned property where it's been moved to a company you 100% own, you must sell at open market value. You can't use any form of consideration. HMRC is very, very clear on this rule. Next, it's not a refinance or a transfer, it's a sale and it's a purchase. Right at the end, the solicitor, who was brilliant, stepped in and said to my friend, "Are you aware you're going to pay 86,750 pounds in stamp duty, and in capital gains you're going to have to pay 203,280 pounds, a total tax bill of 290. First of all, the mortgage that the broker had arranged under the instruction of the accountant and worked with the accountant was 632,000. So if it had completed, she would have had to have gone and find 290,000, which she would never have got on a remortgage. She also wasn't informed that the current fixed rate she was on would have triggered a 5% ERC, which was again another hefty fee. 5% on a balance of £600,000 odd was a lot of money. Suffice to say, it didn't go through, but was a classic example of where bad advice, and if the solicitor wasn't on the game, there would have been an awful lot of real issues that she would have had to have paid that tax. Ultimately, the person most likely to have been sued for all this would have been the mortgage advisor, because they're the easiest to take reparation against. So just be very careful that whoever is advising the customer knows what they're doing, and that any of your emails doesn't make you liable for any of the advice given. It's just something to watch. However, people do successfully transfer properties from personal to limited without, at the time of incorporation, do not pay stamp duty and do not pay capital gains. And I'm going to take you on that journey. And this is not for you to suddenly go out and then explain this to your customers. This is purely for you to be in an informed position that the clients who are wanting to investigate this, even though you've had some of this very, and I really emphasize, very basic training, is for you to realize that this isn't something you should explain. It's something a tax advisor should explain, and they should pay the money to have that initial consultation. George Osborne's interest relief removal for privately owned buy-to-lets had the consequences that those personal owned portfolios for the high and top rate taxpayers most likely would become unprofitable and sink and go underwater. And everybody since June 2015 have been looking for the holy grail of how to move portfolios from personal to limited without paying any taxes at point of incorporation. And we are aware there's been a lot of very bad schemes that have come to Revenue's attention. And unfortunately, a lot of people will be having very significant tax bills because they've incorporated incorrectly. So let me bring you to the attention of Martin and Amanda. Martin and Amanda have been running a buy-to-let management company of 48 properties that are various management types, including serviced, and having within the portfolio properties that have an element of fully serviced becomes a key aspect of what's called the Ramsey ruling. More on that to follow. It's about being able to demonstrate that Martin and Amanda are full-time employed within managing those portfolios, not just the passive holding of a portfolio. So if Martin and Amanda had 48 properties fully managed by a letting agent, then that would be classed as passive holding, not managing portfolios as a business. They also run it as a partnership. So you'd be very much aware, or you may have heard of LLPs, where people have gone on a journey of transferring portfolios into an LLP, and maybe one of the partners in the LLP is a limited company with the beneficial interest of everything being passed into that limited company. These are the sort of schemes that I'm not going to go into today, but HMRC have taken a very dim view because they weren't open, honest and transparent against the revenue's rules. And the revenue are very clear about who can and cannot qualify. But in this situation, Martin and Amanda had set up a partnership under Section 45 of the Partnership Act 1890, where it's two or more people come together to make money. Simple point of a partnership. And what they want to do is to move their entire portfolio into a limited company. They want the protection and status of a limited company. The fact or the reason, if they were to just want to incorporate purely so they could carry on offsetting the interest, would actually be classed as tax evasion. So you need to be very clear, very transparent, and get the right advice as to why you want to incorporate. But what they wanted to do was to understand, should they seek full tax advice, ensure that they're in an informed position, and consider incorporation tax relief, Section 162. Now, at this particular point, I don't want to confuse you, but I want to make it very clear. A partnership is only relevant to stamp duty. For capital gains, it can be an individual or it can be a partnership. The perfect combination for covering off both capital gains and stamp duty on incorporation is a partnership, because the partnership ticks the box for stamp duty, but the partnership can also tick the box for capital gains. However, an individual qualifies potentially, and I say potentially with both of these, but not for stamp duty. So let's look at capital gains first. Incorporation tax relief is the allowance of a trading business that meets the rules to be able to incorporate and the right to incorporate without triggering capital gains at the point of incorporation. However, it's simply deferred if they meet the rules. What Martin and Amanda wanted to do was transfer a business as a going concern into a company in exchange for shares. Now, there isn't a time frame on how long that partnership has acted for. Quantification with a tax advisor needed, but the 36-month rule, which is often bandied around, is to do with stamp duty, not with Section 162. Section 162 is whether or not you are seen to be running a full-time property-led business. For the example of this, let me give you the following. Martin and Amanda purchased a portfolio for 2 million 30 years ago. It's now worth 10 million. So if I said to you on these figures, if they bought 30 years ago for 2 million, it's now worth 10 million, and they sell that portfolio, how much gain have they made? So they bought for 2, sell for 10, what is the gain? The gain is 8 million. Very simple. So just imagine Martin and Amanda had purchased a portfolio for 2 million, 30 years on it's 10, and they sell, which is what they're going to do, is sell. They're going to sell that portfolio. If they sold it to somebody else, they'd have an 8 million capital gains bill. However, they're going to sell it to their brand newly formed SPV, and they are going to transfer that into, and it's going to be the capital gain is going to be incorporated within the share value, but having a base cost of 2 million, which was the original purchase price, but it's noted there's an 8 million gain. At any point in the future that they decide, for example, to bring their children on as shareholders and give them a percentage of the shares, and this is at any point, whether it be a year, 3 years, or 6 years after, it can't be done at incorporation, but maybe in the future they look to do that at any point that the shareholding is reduced or they sell their shares in the company. In other words, they sell the shares to someone else, the company sold, that will therefore trigger that 8 million gain. So at some point between the incorporation and death, that will trigger that capital gain bill. So that is section 162 explained quite simply. So capital gains is not avoided, it's simply transferred, and there's a time mechanism for when that will need to be paid. And that is very simple to understand. When it comes to stamp duty is dealt with differently. It's partnership incorporation relief rule from Schedule 15 of the Finance Act 2003, paragraph 20. It's about a partnership transferring a property from that partnership to a newly formed limited company. For context, it's called the sum of low proportion relief. For landlords operating through a partnership, there may be a way to incorporate the business, transferring to a limited company without paying stamp duty land tax, provided certain conditions are met. What's the relief? It's known as partnership incorporation relief. It's based on the sum of low proportion, which is Rule Schedule 15 of the Finance Act 2003. It allows full or partial stamp duty relief when a genuine partnership transfers a property to a connected company. Key conditions: the partnership must have accepted or existed for at least 3 years. So that means they would have had what's called a UTR, a unique tax reference number, that would have been registered with the revenue under that section 45 of the 1890 Partnership Act. You don't need any of this LLP nonsense, simply a one-page form. And as long as that's run for 3 years, that is the first box potentially ticked. The limited company must be owned by the same individuals in the same proportion. So if it was Roger and Katie 50-50, the limited company shares would have been equal in their division. There should be no money changing hands under the possible transferring of debt and mortgages, and it must be a genuine transfer of the property business, not just a one-off property. It is absolutely imperative that the properties are transferred at full market value. No consideration can be given. In fact, this is the only exception of where the transfer must be at full market value. If I decide to sell my properties through an estate agent to a non-related party, I have the right to sell them at whatever price I wish. But when transferring properties from my personal name to a company that I own, then they must go through at full open market value. How it works: if partner A and B own 50% of the property, then they must own 50% limited company. Then no stamp duty land tax is payable because the beneficial interest hasn't changed. You must make sure that you get full tax and legal advice, as HMRC will look at the ownership structure. Full stamp duty tax returns must be put through, because you get an awful lot of challenges from solicitors saying, well, if I put it through at full market value, stamp duty tax will be payable. Not if it goes through on a return stating it's been done under the sum of low proportion relief rules Schedule 15 of the Finance Act 2003 and meet the revenues rules. If it doesn't, then the stamp duty will be payable. Hence, you must get that full tax advice. The Ramsey ruling, which we're about to cover next, is wholly related to property-led business. It's not related to stamp duty. So do not get confused between the two. Stamp duty is partnership. Incorporation, section 162, can be individual or partnership. So the Ramsey ruling, section 162, was where Elizabeth Ramsey had moved her portfolio into a limited company and wanted to use section 162. I'm holding up, I'm not sure if you can see on camera, a court document that was downloaded from the internet, and it is to be searched. Look for capital gains tax section 162, rollover relief on transfer of a business as a going concern to a company in exchange for shares, whereas activities are apparent in relation to the property divided into let flats amounted to a business where the approach of the first tier tribunal was correct in law. And this was between Elizabeth Ramsey and HMRC. Elizabeth Ramsey against HMRC was a case brought to that upper tax tribunal in Belfast on the 27th of March 2013. Elizabeth Ramsey was challenged by the Revenue on one exclusion, and the only exclusion on any trading business at that time was the passive holding of investments or the holding of properties as investments amounts to a business. So the Revenue just wouldn't accept that if you had 38 properties, whatever, in this situation, 5 flats which were occupied in a multi-unit freehold building that was actually comprised of 10 flats. So 10 flats, 5 occupied, 5 not, that would actually amount as a business. Since the court ruling with the Ramseys, these words have been reviewed and removed, and states the Ramsey case endorsed the approach, confirming that for there to be a business of incorporation relief, there has to be activity and not just a modest degree of activity. So let's say if they had 5 flats managed by a letting agent, that wouldn't be a business. One could argue 5 flats, was that a full-time job? But the Ramseys were able to just be able to prove without doubt that it wasn't just a modest degree of activity. There was actual quantity and quality of the activity that was important. The Ramseys had to prove in court that they had activities and servicing of these 5 properties, these 5 flats. At the time, the building was 10 units, a multi-unit freehold building, 5 occupied and 5 not, but it was full-time for the Ramseys. They were able to demonstrate the following to the court: administration of the property, responsibility for checking and payments in communal areas and blocking drains on many occasions, oiling and reattaching hinges and door locks, maintaining flower beds, hedges and communal space. And when the flats became empty, they had to clean, paint, remove rubbish and prepare the flats for the new tenants. This all became the basis to set standards for meeting the minimum rules. So what can landlords learn from this? And the case, that was several pointers that came out this particular tax tribunal that is well documented on the internet. As landlords, you need to be open, honest and transparent with yourself and with the Revenue. If you're the landlord, to make sure that you meet the minimum standards before you even consider going down this route. Most do not qualify. Do not manufacture a scenario just to try and get incorporation, because that will be deemed negative with the HMRC and is not being open, honest and transparent. You need to consider if you meet the criteria, and it's more likely that a larger portfolio rather than a smaller one will be treated as a business. It's more likely that properties that are not within the same prop will be treated more favourable. So that's the basis of the rules, but think of the process. First of all, the ownership. So in this scenario, the ownership of the portfolio was under Roger and Katie as a trading partnership, and this partnership, and the reason we're quoting a partnership is because ideally you want to be able to qualify for both stamp duty and capital gains, which is why I'm using a partnership, not an individual. The ownership of the newly formed SPV, same directors, same shareholders. You can't add on children, remove or dilute shareholding. It must be an absolute mirror. If not, it would not qualify for this. All properties need to be transferred on the same day. So the entire portfolio needs to be transferred to the limited company. This is significant. What normally happens is the mortgage advisor gets that involved with areas of tax advice which is not relevant to them at all. They become fixated with the capital gains and fixated with stamp duty. But actually, potentially, with the right advice, they can either not be applicable at the time of incorporation, or simply incorporated within the share value, that what they actually do is forget the fact that the early repayment charges are actually payable. So imagine you had 48 buy-to-let properties. I can imagine that. And the 48 buy-to-let properties to be incorporated on the same day are not going to be on SVR, because the interest rate payable could be absolutely breathtakingly high. So how do you get 48 buy-to-let properties on SVR? There's your first challenge. Or you might pick a buy-to-let lender that is happily to novate the debt. So what they do is, by rechecking the legals and the tax advice to make sure that, as the best of the knowledge of that lender, that they qualify for incorporation, that they allow the novation of the debt through and the transfer of ownership to occur on land reg from personal to limited. CHL Mortgages, to be clear, does not do incorporation tax relief. We do not do Section 162. We will allow the sale of properties where capital gains is paid on sale and stamp duty is paid on purchase into the limited company. Standard, straightforward, full taxes being paid, and any early repayment charges you would logically wouldn't think would occur, because you do them as they became on SVR. But to be able to incorporate, your three taxes would be stamp duty, partnership needs to have run for 3 years and needs to qualify. Capital gains needs to meet the rule as a trading business with servicing, and it needs to be able to qualify for HMRC, and that's just transferred into the value. So the big one actually becomes early repayment charges. Hopefully that will have answered the questions. Normally at this point, we would be having John McCaffrey, who is the tax advisor, who would happily then step in and explain how all these things work from a tax point of view and answer your generic questions. But what we will be doing is running many surgeries and clinics live with John and the team from Alexander & Co. that will hopefully be able to answer those questions live. What I've tried to establish with you today is to give you nothing more than my rudimentary and basic explanation of how incorporation works. This does not constitute tax advice. This isn't something you should explain to your customers, but it might give you the beginnings of the understanding to allow you to do research on the internet, research the Ramsey ruling, research the sum of proportion relief when it comes to stamp duty, and then, and under no circumstances, give tax advice, but then have a relationship with a tax advisor who can then quantify that information. So that comes to the end of this presentation. As we said, we can't ask any questions because this is recorded and not live. So I'm going back to the studio to Natalie to finish off.
Thank you, Roger. Again, another great presentation by you. So that brings us to the end, and we will see you hopefully on our next webinar soon. So take care. Thanks, everyone.